Today I want to talk about compounding and how the media sometimes lies to you about this spectacular financial phenomenon. I will unveil 4 different misconceptions when it comes to the power of compounding that I think every private investor needs to be aware of. So without further ado, let's get started. Alright, hi there, my name is Ray Zellman and this channel is about long-term investing and quality stocks. But of course, every once in a while I also talk about more fundamental personal finance concepts. I've actually just recently released a video on the power of compounding and outlined why it is my #1 wealth building secret. And in it, I shared the following visualization. I'm just going to show it to you again here that nicely illustrated how over time the power of compounding, the wealth building process picks up pace. So I was showing that if you are investing just $1,000 a month for 30 years, you will end up with more than $2 million US. However, just reaching the first $200,000 will take you 33% of that entire time period. So almost 10 years. The other incremental $200,000 that you then gain over time will be achieved much more quickly. Going from $600,000 to $800,000, for example, only takes you 8% of the total time needed to get to the $2.2 million US you see at the end. Going from 1.4 million to 1.6 million US only takes you 15 months. So a little more than a year. And I guess the key takeaway from this illustration is that you have to play the long game in investing if you want to do well. Now, while clearly the power of compounding might be the most underestimated tool in every investor's toolkit, I think there are a couple of misconceptions surrounding this phenomenon. Because after all, I will show you that the power of compounding in the real world, due to a couple of different factors, is not as powerful as the media sometimes wants you to believe. So again, we are going to take a look at a specific case, and let me just outline some of the assumptions that I have made here. So we are assuming once again that we are investing for the long term, 30 years. We are investing $1,000 a month, so that's $12,000 US annually. Our money is compounding on an annual basis, and it is compounding at an annual rate of 10% a year. So basically, we are assuming an investment in a passive ETF. I know some people might point out in the comments down below that going forward, the return you can expect from a broad passive ETF is maybe a little lower, but we want to simplify it and just use some round numbers here. So 10% a year over 30 years, $1,000 a month. If we put these numbers into a compound interest calculator, you will see that after 30 years, you will end up with a net worth of $2.08 million US, which is not bad for someone who is just earning an average income and contributing an average amount every single month for a long period of time. However, and I'll get to the point of this video, I think there are a few factors that you need to take into account, which will make the final outcome look a little less impressive. The first one are fees. I just said we're investing in a broad market ETF, and even the cheapest ETFs in the world, they still charge you a fee for the service that is provided by the ETF provider. Some of the cheaper ETFs, the broad market ETFs by the big ETF providers, they charge total expense ratios in the range of 0.1 to 0.2%. So if we head back to our compound interest calculator now, and instead of assuming an annual return that is compounding over time of 10%, go for 9.8%, this already reduces our final net worth from $2.08 million US to just shy above $2 million US. So over time, over 30 years, the 0.2% in fees that I was assuming here will cost you around $80,000 US, which brings me to the second factor to be aware of. And this one is even more meaningful: taxes. Now, let me walk you through the inputs and the assumptions I was making here. So of the $2 million US that we end up with after 30 years, around 1.64 million were capital gains. The other 360,000 US were basically our contributions that we made over the 30-year time period. But the capital gains, they will of course be taxed. And I was just taking into account the tax rate that I, as someone living in Germany, would have to pay once I realize these gains. And the capital tax rates in Germany, as of today, is around, or maybe not around, it's pretty precisely 26.375%. So 26.375% of the $1,641,000 US in capital gains represents $432,000 US. So of course we have to deduct this from our final net worth, which brings us to a final net worth after 30 years of $1.568 million US. All right, before we move on to factor number 3, I would like to know from you, where do you live and what is the current capital tax rate in your country? Please share it in the comments down below and let me know what you think of what kind of capital gains tax you think would be appropriate to charge by the government. Okay, with that being said, factor number 3. The third factor that is going to eat into your actual returns is inflation, because after all, oftentimes it is distinguished between nominal returns, so that would be your return before taking inflation into account, and your real returns, which adjust your returns to the inflation rate over that holding period. So we just figured out that after fees and after paying capital gains tax, we end up with around a little more than $1.5 billion US. What I was doing now, I was taking a look at an inflation calculator that calculates the purchasing power of a specific sum of money considering specific inflation rates. And I was assuming an inflation rate of just 2%, which is lower than the inflation rate we are experiencing right now, but it's basically the target of most central banks around the world. And if we are assuming an inflation rate of 2% over 30 years, well, then our final net worth, the $1,568,000 US, will only have a purchasing power of $865,000 US in 30 years. So again, this is also a major headwind, and of the 3 we have discussed so far, the biggest headwind. So the only way to actually tackle this would be to adjust your monthly contributions accordingly. Adjust your monthly contributions as your salary rises, hopefully in line with the rate of inflation. I've actually done the calculation here. So if we are adjusting our annual contribution by just 2% annually, we will end up with $2,383,000 US after 30 years, assuming a rate of return of 9.8% annually. But again, this would be before taking into account capital gains taxes. And then finally, risk number 3 and factor number 3 that I think you have to be aware of is the so-called sequence of return risk. So the problem I have with some of the calculations you see online is that they are assuming stable returns over long periods of time. But if we just take a look at the returns over the S&P 500 annually, for example, you can see that the annual returns actually fluctuate quite heavily. And when it comes to modeling where you will end up financially after 30 years, and assuming you are making constant contributions, how the annual returns are distributed will have an impact on where you end up financially after 30 years. This is called sequence return risk. So whether you can contribute a lot of money early on while the market is actually flat for a long period of time, or whether you have to contribute early on when the market is trading at elevated levels and will have lower returns in the later years. Well, this has an impact on your long-term financial performance. So as the graph on the right shows, it was actually generated with AI, and I think it's not fully accurate, but it gets the point across. You can come up with 2 different scenarios that will have the same compounded return over the 30 years, but the returns are distributed differently. Well, you will have different financial outcomes after that 30-year period. So what is my conclusion after talking about all of these different factors? Well, the point of this video is not going to say that the compound interest calculators are worthless. Now, I think quite the opposite is the case. I think using these compound interest calculators can be a real eye-opener, showing people how well they can actually end up financially if they start early on, if they contribute consistently, and if they do it following a smart system. But you also have to understand which kind of headwinds will eat into your return, and maybe they can motivate you even more to start even sooner, to maybe contribute more over time, to adjust your contributions according to the inflation rates, to increase your income if possible, which also includes working on your skill, making your skills more valuable to the market, so that ideally you can even increase your contributions disproportionately at a rate even higher than the inflation rate. If you can do all of this, I can promise you will do very well financially. And that's it for today. See you in my next video. Take care.